I just rebalanced my entire portfolio, cutting out 4 positions completely and adding 4 completely new ones, all focused on long-term growth. I just made a video about the AI bubble and my thesis on how the next couple years of investing can look like. So go check that out because I'm going to reference it a lot and it's kind of the basis for this whole change. But this is the 48th dividend income report video where I go over what stocks I've been buying and selling, my best and worst performers, and my dividend payments. Might have to rename that because a lot of the stocks I cut were dividend payers, but for today's episode, we're going to keep the format similar. The entire first part is going to be about my new rebalanced portfolio. I'm going to talk about each position. I'm going to talk a little bit about the stocks I sold, and then I'm going to go over some of the usual stuff I go on all the other episodes. But to start the video, let's look at my new portfolio. The new portfolio has 9 positions, 5 old ones, and 4 new ones. I'm going to just talk about each position in my portfolio and then say if it's new or old, and I'm going to explain why I like them. So the first position is my largest percentage holding, SCHD, at 20% of the portfolio. SCHD is the Charles Schwab Dividend ETF. It is made up of blue chip dividend payers that in the event of a recession or market crash would be able to keep generating revenue and not swing down too hard while also paying dividend income. So my portfolio would be able to kind of hold its own in the event of a market crash. In my last video, I talked a lot about having good quality ETFs in your portfolios. This is one of them. It has around a 3.5% dividend yield, and that would go up in the event of a market crash. It keeps up growth-wise pretty close to the S&P 500, sometimes even beating it. So by having this in your portfolio, you're not going to be lacking in the growth department either. This is my sleep well at night position. Just have something I can know will hold my portfolio together no matter what. The next 3 positions in my portfolio are mega cap growth stocks, and this is what I was talking about in the last video. These are all companies that are going to have a lot of revenue happening right now, not a lot of debt, and the ability to invest and grow in times when other companies cannot compete. So that is kind of the baseline for all 3 of them. The first one is Amazon, and I have it at 15% of my portfolio. Amazon has AWS, Amazon Web Service, and this is just a cloud technology that AI can run on. It's very valuable and is the leading growth in cloud service. They also have complete dominance in the e-commerce market, so anything you buy online is most likely going to be through Amazon. Amazon also appears to be in talks to make a large investment into OpenAI at around $50 billion. I believe this is because when OpenAI has ChatGPT start advertising products, those ads could be linked to Amazon, and I think Amazon wants to make sure that's the case so they can have more traffic and just even more dominance over the field. Amazon is also in a position where a lot of their labor force in their warehouses could be automated by AI and just taken over by AI for a lot cheaper. So if that were to be the case, Amazon would have a lot less expenses and a lot more revenue. And I think they're just more positioned to benefit from AI and robotics than a lot of other companies. So that could be pretty valuable for Amazon as well. And another thing, they are also a dot-com survivor, so they've been through this before. They understand the importance of patience and investing long-term, thinking long-term. So that's why this is a company I plan on holding for many, many years, not just the next couple of years, and speculate. I also have Microsoft at 15% of my portfolio. A lot of similarities to Amazon. They have Microsoft Azure, their cloud service, just like AWS. And this is just what is necessary for AI to have computing power and data storage. So extremely valuable in this day and age, and it's continuing to grow a lot. They also have Office 365, which is extremely valuable. Office 365 is ingrained into white collar America. So the more they can integrate AI into their services, the less companies have to look elsewhere, and the more likely they are to stay with Microsoft. Microsoft is doing a great job at integrating AI into their services, like Azure AI Copilot for Office 365, Copilot for GitHub, one of their programmer services. Stuff like that is happening right now and will be extremely valuable for long-term growth. Even if my assessment of the future of AI is wrong, they have diverse sources of income from multiple different places, so they're not reliant on one thing, and they have a lot of cash on hand to keep making investments, and they're not taking debt to make these investments. So it's kind of a safety blanket to get exposure with less risk. And we're not thinking about short term here, we're thinking about many, many years into the future. This is a long-term hold, not a short-term speculation. The last mega cap tech stock I have is Google, and I have it at 10% of my portfolio. Google has 90% of the global search market, which prints them a ton of money and brings them in a ton of revenue. They also have YouTube, as they own YouTube, which you're watching right now, which brings them a ton of advertising money. So this is a very established company that's making a lot of money and does not need to take debt out to do AI research. They have Google Gemini, which everyone knows is great, but they don't have to be as public with their findings from research and development, because a company like OpenAI needs to be public about their research, their new products that could potentially be coming out, to get investors to invest in them so they can actually fund it. Google does not need funding. They do not need to take any debt out or get anyone to invest in them, so they can kind of be more quiet about their products and development. And I think they have more than they're letting on. There are some regulatory risks, and if another company were to crack AGI before them, I do think that would hurt revenue, especially from like Google as a search engine. But I think they're in the best position to make these advancements first and reap the rewards of them first. So that's why I want to have some exposure to Google. And I also forgot to mention before, they have the third biggest cloud service in Google Cloud, right behind Amazon and Microsoft. So that is something to note as well. This is a long-term investment, hoping to pan it out for 10, 20 years. And then you'll be able to see if my correction or my prediction is correct, that they are able to make these AI advancements first. My fourth stock is Regeneron, a biotech company, and it's about 15% of my portfolio. This is a stock I've been really big on for a very long time. It's been one of the growth stocks I've been most vocal about, and there's a lot of things I like about this company. They make billions in revenue from their drugs that they have currently, like Eylea, like Dupixent. They have a large market. They also have a very strong pipeline for research and development and bringing drugs to the market. There's currently a couple drugs, in this pipeline that I'm bullish on in the future. I've talked about them in the past. One of them is like an Ozempic-like drug that prevents muscle loss. So a lot of people that were taking Ozempic would lose muscle along with fat. This would kind of prevent you from losing muscle and just focus on losing fat. If this were to come to market, I think it would just be huge, and it's not talked about a lot. And they also have a lot of cancer drugs in development. And with their success on cancer treatment in the past, I think there's a strong possibility those drugs in development will do very well when they come to market, assuming they do. There are some risks to having a biotech company because it's very dependent on FDA approvals, drugs coming out on time, stuff like that. So it's kind of hard to predict what will happen with that. But we have an aging population, a growing need for healthcare, and a kind of prediction I made maybe a year and a half ago was that AI would be very good for research and development. I thought that would be one of its best use cases, and so far that's been pretty accurate. AI has done a lot for research and development in the biotech sphere. That's one of the applications of AI that has been very successful, and I think will continue to be very successful. My fifth stock is Visa, to give me some exposure to financial infrastructure. Visa is a company that deals in transactions, and they get a piece of every transaction. This is very low cost for them. So as volume explodes, their costs aren't really going up that much, so they're able to make a lot more profit. There's no credit risk. They're not lending out money, and the world continues to move away from cash and over to digital, which just gives this company more room to make money. This stock doesn't have a lot of AI risk because it's not tied to AI, so that's another reason to have it in this portfolio. The next stock in my portfolio is Cameco Corporation, ticker CCJ. They are the largest publicly traded uranium mining company. They also have a large stake in Westinghouse, which is a nuclear reactor technology company, so they have exposure to all parts of the nuclear energy pipeline. AI requires a lot of energy to run to power the data centers, so I think nuclear energy will be very big in the future. Both Democrats and Republicans in the United States agree that nuclear energy is something they want to see more of in the future, so I think that says a lot. And I think in general, most countries are trying to move towards nuclear energy because of the carbon benefits. There currently is a supply deficit of uranium for nuclear energy, so companies like Cameco will always have buyers for their uranium. And this is a company that currently has revenue and multi-year contracts, so this gives my portfolio some sustainability and exposure for possible long-term growth, assuming nuclear energy grows a lot in the United States and the rest of the world. And even if AI or my prediction for the future of AI does not come to fruition, we're still demanding more energy. We're moving away from fossil fuels, and I think nuclear energy, regardless, is going to be a big part of our future. My last two stocks are just speculative AI plays, each at 2.5% of my portfolio. The first one is SoFi. This is a FinTech online bank. They target millennial and Gen Z customers. They started as student loan refinancing and have moved to become more of a traditional bank with a checking, savings account, and giving out loans. So I have it at 2.5% to mitigate risk, but have a lot of upside. My last position is APLD, Applied Digital, and this is a purely AI infrastructure play. This is directly going to be based on the performance of AI as a whole. They design data centers and focus on high performance computing. So in the event that AI crashes and becomes worthless, this stock will probably go to zero. But if AI becomes a huge part of the world in the next 10-20 years, this position has a lot of room for upside and could probably 10x in the future. But that's why it's a high risk play and only 2.5% of my portfolio. So that's my current portfolio as it is now. Aside from these investments, I also want to mention my cash position, which is around $10,000. This is sitting in a CD account earning 3.5% interest. And the reason I have such a high cash position is in the event that any of these stocks has a big dip if the AI bubble pops. These are all companies I plan on holding long term, so I can buy up these long-term holds at cheaper prices and make a lot more money on the rebound. So now let's talk about the positions I sold. The first one was Altria Group. This is a dividend tobacco company that doesn't have a lot of growth but has pretty high dividend yield. Just doesn't really fit with this portfolio and my future growth targets. It's been good in my portfolio. I made about 35% on this stock, not including dividends, and about 50% if you include dividend returns. So it did well for me, and I thought this was a good time to exit that position because it really hasn't had a lot of growth, or it doesn't have a good growth outlook, I should say. The next stock I sold was JP Morgan. It was kind of too similar to Visa, but with less growth ability. JP Morgan was a stock I was buying at $100 a share, so I ended up selling it at over $300, and my total position profited around 50%, so I was able to exit it at a pretty good time. This is a good, strong, stable company that can pay out dividends, but there's not a lot of growth options from here. I don't think it has the same growth outlook as some of these AI plays long term, and I just wanted to exit my position at a good price. Third stock I sold was Chevron. This is also another energy company, but I feel like it doesn't have the same growth potential as nuclear energy. I was able to sell my position at about 30% profit, so I wanted to exit and leave room for my position in Cameco. And the last stock I sold was Realty Income. This has been one of the first stocks I bought in this portfolio. It's been a monthly dividend payer for the past 48 months, and I was pretty happy with it, but it just really hasn't grown a lot since I bought it. There's really not a lot of growth opportunity for this real estate REIT company, so I figured I would cut it out of my portfolio. Dividends aren't really necessary at my age, and maybe it could come back in the portfolio 40 years from now, but doesn't fit with the rest of the stocks in my portfolio, so I had to cut it. I also got about a 27% return from my Realty Income position. I also have a lot of ETFs in my Roth IRA, not just SCHD, so I do have exposure to some of these companies through ETFs as well, so I'm not completely giving up on them. I just don't want to have single stock positions in this portfolio of these 4 companies. So that was filmed about 2 weeks ago, and since then, we started a war in Iran, so some of those stocks like Chevron probably would have been a good hold for at least the next couple of weeks. Hopefully it doesn't escalate. No one wants to be at war. It's already caused a lot of damage, and I probably would have made those changes after this because there might be some volatility in the market. But if prices go down, I plan on just keep buying. This is long term, so that's my thoughts on that. But now I'm going to go over into some of the more month-to-month things that are happening in the portfolio that I normally talk about in these videos. The first thing we're going to go over is the portfolio performance. We'll start by looking at the last recomposition I did on March 5th, 2025. It's been almost a full year, and since we just changed the portfolio, this is the last time we can talk about it. But since then, my portfolio has returned about 16%. The S&P has been about 20.5%. The NASDAQ has been about 24, almost 25%. And the Dow Jones was at 17%. So I underperformed every major index over the last year, which stinks. We learned a lot, and now we have a more growth-oriented portfolio that should do better long term. In the month of February, I made some position changes halfway through. So it's kind of like 2 different portfolios, but I actually outperformed all the indexes at around 1.6%. The S&P had a negative 0.76%. The NASDAQ did negative 3.33%, and the Dow Jones did about 0.31%. So I outperformed all of them. Year to date, I'm up 3.65%. The S&P is up about 0.7%. The NASDAQ is down 2.39%, and the Dow Jones is up 2.12%. So hopefully my portfolio can keep outperforming the indexes, but this is exactly what it looked like a year ago before I made my last recomposition, so you never know. I'm not going to go over stock by stock performance since I made a bunch of changes this month, so we'll save that for next month. But now we can look at the exact dollar amounts I sold and bought of each of the positions. The stocks I sold in February were obviously Altria Group. I sold about 1.2K. Chevron, I sold about 1.4K. JP Morgan was almost 1.5 grand. And Realty Income was about 1.4K as well. So those added up to be about $5,444 worth of sales. Altria Group, my total returns ended up being about $437.30 in profit, almost 50%. Realty Income ended up being around 27%, which was $320. JP Morgan, I profited about $511, which was about 50%. And Chevron profited about $300, which was about 25%. So I actually made money on all the sales, which was a good thing. And hopefully that money is reinvested wisely. With that money from the sold positions, plus $200 in contributions, I'm going to show you exactly how I reinvested that money in each position in dollar amounts, just to bring them to that percentage pie chart I showed you earlier. I bought about $740 worth of Amazon to bring it to 15%. I bought about $1,350 of Google to bring it to 10%. Bought about $251 of SCHD to get it to 20%. And I bought about $335 worth of SoFi to bring it to 2.5%. SoFi and APLD, they're not exactly the same because you can't buy fractional shares of them on Charles Schwab. So I had to buy full shares, so it's not exactly 2.5% each. Microsoft, I bought about $900 worth. Cameco, I bought about $1,254 worth. Visa, I bought about $500 worth to bring to 10%. And APLD, like I said, was about $307 worth. So my total buys equaled about $5,645. Right now, this brings my portfolio to about $13,600, maybe a little more by the time I post this video, but that's where we're sitting at. As far as dividends go, I only got Realty Income, a $5 payment for them this month, so pretty light month for dividends, but March is still going to have a ton of dividend payments because I still get dividends from some of the stocks I sold because of the ex-dividend date. So I'm still going to get about $44 from my positions in March, and that'll make a good video. But from there, my dividends are going to go down a lot. I did sell a lot of dividend stocks to replace them with growth stocks. So now my new dividend stats are lower. I'm going to hold off on talking about the dividend stats because I want to do that in my next video on March 8th. We're going to go over the 4-year results from this portfolio. Been investing $50 every week for 4 years. So I'm going to sum up the total returns in that video. And I'm also going to talk about the new dividend stats. So keep an eye out for that. Thank you for watching. Peace.